Hello, I'm John A.G., and there are moments in markets when something breaks quietly before anyone notices. Not a crash, not a headline panic, but a subtle rupture where normal rules stop working the way they always have. Most people miss these moments because they do not look dramatic on the surface, but once you see them clearly, you cannot unsee them. Something like that happened in China this week, and it tells a story about silver that is far bigger than a price chart or a technical indicator. This was not about volatility, it was about stress, real stress. The kind that exposes where demand overwhelms structure and where confidence turns into urgency. What happened was simple on paper and extraordinary in reality. A silver fund in China halted trading, not because prices collapsed, not because of a system failure, not because regulators intervened after a crash. Trading was halted because demand became so aggressive that the fund's price disconnected from the value of the silver it was meant to represent by 36%. Investors were willingly paying 36% more than the underlying silver was worth just to gain exposure. That is not enthusiasm. That is not speculation. That is a market signaling strain. The fund in question was the UBS SDIC Silver Futures Fund, the only pure-play silver investment vehicle available to Chinese investors. And this detail matters more than most people realize. When that fund suspended trading until 10:30 in the morning Beijing time and stopped accepting new investments entirely, it effectively shut the door on the primary paper silver outlet for a massive population. This was not a sudden decision. The fund had been issuing near daily risk warnings since early December. Trading had been halted repeatedly. Each pause was an attempt to cool demand that refused to cool. Eventually, the managers made a rare admission. They could no longer manage the imbalance responsibly. To understand why this matters, you need to understand how abnormal a 36% premium really is. When a fund tracks silver futures, it is designed to trade close to the net asset value of its holdings. If the fund represents $100 worth of silver exposure, investors should pay something close to $100. Market makers and arbitrageurs exist to enforce this relationship. Small premiums get sold, discounts get bought, balance is restored. That system works until demand overwhelms it. When buying pressure becomes relentless and supply of shares cannot expand fast enough, the premium grows. In this case, it did not just grow, it exploded. People were paying $136 for exposure worth $100. That difference is not noise. It is not inefficiency. It is desperation made visible. The fund itself acknowledged this risk publicly, warning that investors could face significant losses if conditions reversed. When a fund manager explicitly tells investors that prices are detached from reality and still cannot slow demand, the message is clear. Something unusual is happening beneath the surface. What makes this even more revealing is the broader backdrop. This fund suspension occurred while silver hit a record high of $117.71 per ounce. It happened while silver was already up more than 50% since the start of the year. It happened while Chinese silver prices traded above international benchmarks even after accounting for the 13% value-added tax applied to imports. These are not isolated data points. They are aligned signals. They point to physical tightness and demand pressure that most Western investors are still underestimating. And when the only accessible paper outlet for silver exposure in China closes, demand does not disappear. It moves, it redirects, it looks for the next available path. In this case, that path leads directly to physical metal. We are already seeing the consequences. Chinese manufacturers are shifting production away from jewelry and toward 1 kilogram silver bars. This is a critical behavioral shift. Jewelry demand is discretionary and ornamental. Bar demand is monetary. It reflects a desire to hold value directly, without intermediaries, without counterparty risk, without reliance on market access remaining open. When a population as large as China's begins to treat silver less as decoration and more as a store of value, the implications are enormous. And this is happening simultaneously with a surge in industrial demand that has nothing to do with investment psychology. The solar industry consumes silver at scale. Electric vehicles require it. Power infrastructure requires it. This is not optional demand that disappears when prices rise. It is embedded demand tied to long-term policy commitments and technological architecture. This is where supply becomes the limiting factor, and silver's supply dynamics are unlike most commodities. Roughly 70% of global silver production comes as a byproduct of mining other metals, primarily copper, zinc, and lead. That means silver supply does not respond cleanly to silver prices. If silver doubles, producers cannot simply open new silver mines and flood the market. Supply expansion depends on the economics of other metals, long development timelines, permitting, and capital allocation decisions that take years, not months. This creates a structural rigidity. Demand can surge quickly, supply cannot. The only mechanisms that can relieve pressure in the short to medium term are above-ground inventories, recycling flows, and price increases significant enough to force existing holders to sell. When all three mechanisms become stressed at the same time, the system tightens rapidly. That is the environment we are in now. MKS PAMP, one of the largest precious metals trading and refining firms in the world, has stated publicly that current demand conditions are unlike anything they have seen before. This is not commentary from a trader watching screens. This is from an institution that moves physical metal across borders and supply chains daily. When firms like this describe conditions as unprecedented, it reflects real-world constraints, not abstract sentiment. One of the clearest indicators of stress is logistics. In some cases, silver is now being transported by air rather than by sea. Air freight is dramatically more expensive. It is only justified when time becomes critical. When delivery speed matters more than cost, it means inventories are tight enough that delays are unacceptable. This is not routine optimization. It is urgency. Significant volumes of silver are flowing into India as well, a market with deep historical demand for precious metals. At the same time, outflows from COMEX warehouses have shifted pressure across regions. Inventory levels fluctuate, but the directional trend is clear. Readily available silver is shrinking while consumption grows. This pressure does not remain confined to Asia. Elevated premiums in China influence sentiment globally. As Ola Hansen from Saxo Bank observed, sustained Chinese premiums reinforce the perception among traders in London and New York that prices elsewhere may still be too low. This is how global price discovery works. Dislocations create signals. Signals change behavior. Behavior moves markets. When investors see buyers willing to pay 36% above benchmark prices, it forces a reevaluation of what those benchmarks actually represent. The question becomes whether the benchmark is wrong, not whether the premium is irrational. And that question alone can drive prices higher even in markets that appear orderly. This is not hype. It is mechanics. It is how stress propagates through interconnected systems. And it is why the events surrounding a single Chinese silver fund matter far more than they appear at first glance. To really understand why this moment matters, you have to step back from the headlines and look at silver through the lens of structure rather than price. Price is the surface expression. Structure is what determines whether a move is temporary or transformative. What we are seeing now is not simply enthusiasm for silver as a trade. It is a collision between multiple demand forces and a supply system that was never designed to respond quickly. That collision is what creates lasting dislocations. Industrial demand is the foundation of this story, and it is often misunderstood. Silver is not just a financial hedge or a speculative asset. It is a critical input embedded deep inside the physical systems that power modern economies. Its electrical conductivity is unmatched. Its thermal properties are essential. Its antimicrobial characteristics are irreplaceable in certain applications. These are not features that can be replicated easily or cheaply at scale. The most visible example is solar energy. Every photovoltaic panel requires silver paste to create the conductive pathways that allow electrons to flow. As global solar capacity expands, silver demand scales with it. This is not a theoretical future scenario. It is happening now, quarter after quarter, as countries race to meet renewable energy targets and reduce reliance on fossil fuels. Solar installations are accelerating, not slowing, and each installation locks in silver consumption that cannot be undone. Electric vehicles represent another structural driver. EVs use silver in battery management systems, electrical contacts, onboard electronics, and charging infrastructure. As vehicle fleets transition from internal combustion engines to electric drivetrains, silver consumption multiplies across millions of units. This transition is being driven by policy mandates, environmental regulation, consumer preference, and long-term cost dynamics. It is not sensitive to short-term metal price fluctuations. Manufacturers cannot pause production because silver is expensive. They must secure supply or fall behind competitors. Beyond solar and EVs, silver is embedded throughout the technology stack. Data centers that support artificial intelligence, cloud computing, and global communications require silver for efficient thermal and electrical performance. Telecommunications infrastructure, including fifth-generation networks, relies on silver components. Advanced electronics depend on it. The digital economy rests on a physical foundation that includes silver, whether most people realize it or not. Or, at sufficiently high prices, some industrial demand can be substituted. Engineers can redesign systems to use copper, aluminum, or alternative materials if cost pressures become extreme. But this substitution is not instantaneous. It requires research, testing, certification, and retooling of manufacturing processes. That takes time. In the interim, manufacturers must pay prevailing market prices to keep production lines running. This creates a lag effect where industrial demand remains strong even as prices rise sharply. At current price levels above $110 per ounce, cost pressure is very real. Companies are aware of it. Procurement teams are feeling it. But the broader transition toward electrification and renewable energy is not optional. Regulatory frameworks, investor expectations, and competitive positioning all reinforce this direction. That means industrial demand provides a durable floor under silver prices even during periods of volatility. Now layer investment demand on top of this foundation. The Chinese fund suspension is not an isolated curiosity. It is a symptom of broader investor behavior. When access to paper exposure is restricted, demand shifts toward physical ownership. This is already visible in the redirection of manufacturing capacity toward investment bars. It reflects a preference for tangible metal over financial representations. This behavioral shift has consequences. Physical demand removes metal from circulation. It tightens inventories. It increases delivery times. It amplifies premiums. Unlike futures contracts that can be rolled or settled in cash, physical metal represents a final claim. Once it is held by an end user who intends to store it, it does not easily return to the market. These dynamics feed directly into the gold-silver ratio, which remains one of the most informative relative valuation tools available. With gold trading above $5,000 per ounce and silver around 115, the ratio sits near 44 to 1. That means it takes approximately 44 ounces of silver to buy 1 ounce of gold. Historically, this ratio has fluctuated widely. During periods of financial stress or neglect of precious metals, it has expanded to 80 to 1 or higher. During strong precious metals bull markets, it has compressed significantly. At the peak of the last major cycle in 2011, the ratio reached roughly 32 to 1. From that perspective, the current ratio suggests that silver has been outperforming gold aggressively. The compression from over 80 to 1 in mid-December of last year to the mid-40s today represents an extraordinary move in a short time. Silver has been catching up rapidly. If the ratio were to return to 32 to 1 while gold remained near $5,000, silver would trade around $156 per ounce. That is not a forecast. It is a mathematical implication of historical relationships. It illustrates the upside potential if relative valuation patterns repeat, but speed matters. The velocity of this ratio compression is unusually high. Moves of this magnitude typically do not occur in a straight line. Markets need time to digest gains. Corrections and consolidations are part of the process. Rapid advances create crowded positioning, and crowded positioning increases vulnerability to pullbacks. This does not invalidate the broader thesis. It highlights the importance of discipline. Volatility is not a sign that a bull market is broken. It is the mechanism through which weak hands are removed and strong hands are rewarded. Silver has a long history of sharp drawdowns even within powerful uptrends. The macroeconomic backdrop reinforces this complexity. The US dollar has been weakening against major currencies. Political leadership has signaled tolerance for this weakness, viewing a softer dollar as supportive of exports. Dollar depreciation directly affects commodities priced in dollars. It makes silver cheaper for international buyers and supports external demand. Monetary policy expectations further shape the environment. The Federal Reserve is expected to hold rates steady following 3 consecutive cuts earlier in the year. Market participants are focused on forward guidance, searching for signals about the pace and direction of future easing. Lower interest rates reduce the opportunity cost of holding non-yielding assets like precious metals. As yields fall, the relative attractiveness of silver improves. At the same time, central banks continue to accumulate precious metals. This is not speculative behavior. It reflects strategic decisions by sovereign institutions to diversify reserves away from dollar-denominated assets. When central banks buy gold, and increasingly silver, they are expressing concern about long-term currency stability and geopolitical risk. Institutional analysis is beginning to reflect these realities. Citi's commodities research team raised its 3-month silver price target to $150. This call was based on elevated geopolitical risks and concerns over Federal Reserve independence. When a major global bank publishes such a target, it signals that bullish scenarios are being taken seriously within professional risk frameworks. None of this guarantees that prices will move smoothly or predictably. Targets are estimates, not promises. Conditions change. Markets overshoot and undershoot. But the presence of institutional support reinforces the idea that the current environment is structurally different from previous false starts. This convergence of industrial demand, investment behavior, monetary policy, and geopolitical uncertainty creates a setup where silver is being pulled from multiple directions simultaneously. Supply remains constrained. Inventories are finite. The margin for error narrows, and when margins narrow, markets become fragile. Small shocks produce outsized reactions. That fragility is not always visible in price until it suddenly is. What we saw with the Chinese fund was not a cause. It was an early signal. At this point, it becomes important to separate excitement from understanding, because markets like this punish people who confuse the two. Everything discussed so far points towards strength, but strength does not eliminate risk. In fact, it often amplifies it. Silver has a long history of dramatic advances followed by equally dramatic pullbacks. That pattern is not a flaw. It is a feature of a market where liquidity is thinner, sentiment swings faster, and leverage magnifies emotion. One of the most overlooked aspects of the current environment is how physical premiums interact with paper prices. In normal conditions, the price quoted on a screen and the price paid for actual metal remain tightly connected. Arbitrage ensures that gaps close quickly. But when physical demand accelerates and supply tightens, that connection weakens. Premiums expand, not as a temporary inconvenience, but as a reflection of real scarcity. Right now, buying physical silver requires paying spot price plus a premium that varies by product, region, and dealer. During calm periods, that premium is manageable. During stressed periods, it becomes substantial, 10%, 15%, sometimes more. This creates a trap that many people fall into without realizing it. If you buy physical metal at a high premium and later sell during a calmer period, you may lose money even if the spot price increased. The premium collapses on the way out. Direction alone is not enough. Execution matters. This is why process is more important than prediction. You can be right about silver's long-term trajectory and still harm yourself by acting impulsively. Physical metal has friction. Storage, transport, bid-ask spreads, and premiums all affect outcomes. In volatile environments, these frictions widen. They become part of the market's discipline mechanism. The 36% premium observed in China is extreme, but it is revealing. It tells you that buyers are not acting casually. They are acting urgently. Urgency combined with constrained supply is the fuel that drives extended moves. That premium will not persist indefinitely. It will resolve either through supply meeting demand or through prices rising enough to restore balance. But the existence of such a premium is a signal that equilibrium has already been disrupted. Inventory data reinforces this picture. Registered silver stocks in key vault systems have declined dramatically over the past several years. Some estimates show registered inventories down more than 70% since 2020. Inventory metrics require careful interpretation, but the direction is unmistakable. Deliverable silver is shrinking while demand grows. The buffer that absorbs shocks is thinner than it used to be. When buffers thin, markets become sensitive. A handful of large buyers choosing physical delivery over paper settlement can create ripple effects that propagate quickly. This is how stress moves through commodity markets. It does not announce itself politely. It emerges through small dislocations that compound. Skepticism is natural, especially for those who have watched bullish silver narratives fail in the past. Predictions of $100 silver have circulated for decades. Many arrived early, some arrived wrong. That history creates fatigue, but fatigue can also blind people to genuine change. The current environment differs from prior cycles in meaningful ways. Industrial demand is structurally higher than it was 10 or 15 years ago. The renewable energy transition did not exist at today's scale. Electric vehicles were a niche. Data infrastructure was smaller. Today, these sectors represent persistent, growing consumers of silver. The geopolitical backdrop has also shifted. Trade fragmentation, sanctions, reserve diversification, and concerns about currency stability have altered how governments and institutions think about hard assets. Precious metals are no longer viewed solely as relics or speculative tools. They are strategic components of resilience. Monetary policy trajectories add another layer. Persistent deficits, expanding balance sheets, and political pressure on central banks all contribute to long-term currency dilution. This environment favors assets that do not rely on promises. Silver, like gold, exists outside the credit system. That characteristic becomes more valuable as trust in institutions fluctuates. None of this guarantees outcomes. Markets remain unpredictable. Prices overshoot. Sentiment reverses. Timing is uncertain. But dismissing the current setup because previous attempts failed ignores the evolution of underlying conditions. This is where discipline becomes critical. Silver can easily pull back $20 or $30 from current levels and still remain in a structural bull market. Such a move would feel violent. It would test conviction. It would tempt people to abandon positions at the worst possible moment. That is how wealth transfers occur. Position sizing is the first defense. Never allocate so much that a normal pullback forces you to act emotionally. In silver, volatility is not an anomaly. It is standard behavior. If a 15 or 20% drawdown would cause panic, the position is too large. The second defense is clarity between thesis and prediction. A thesis describes why an asset should perform well over time. A prediction describes when and how fast. A thesis can be correct while predictions fail repeatedly. Confusing the two leads to frustration and poor decisions. The third defense is alignment between strategy and instrument. Physical silver is fundamentally different from leveraged paper exposure. Physical metal is slow, tangible, and resilient. Paper instruments are fast, liquid, and unforgiving. Each requires a different mindset. Problems arise when people treat one like the other. Understanding which game you are playing matters. Long-term holders should not react to short-term noise. Traders cannot ignore it. Acting outside the rules of your chosen strategy invites mistakes. The Chinese fund suspension, elevated premiums, air freight shipments, and inventory declines all point to the same conclusion. The silver market is operating with less slack than it appears. Stress is building unevenly across regions. Signals are emerging quietly before they become obvious. Markets rarely reward those who wait for perfect clarity. By the time consensus forms, much of the opportunity is gone. At the same time, markets punish those who rush without preparation. The balance lies in informed patience. The question is not whether silver will move higher in a straight line. It will not. The question is whether the structural forces now in place are strong enough to support higher prices over time despite volatility. That answer remains uncertain, but the evidence suggests the possibility cannot be ignored. What happened in China was not an isolated incident. It was a glimpse into how constrained systems behave when demand accelerates. It showed what happens when access matters more than price. It showed what urgency looks like when it surfaces. Whether this moment marks the early stages of a larger revaluation or simply another chapter in silver's long history of false starts will only be known in hindsight. But the conditions shaping this market are real, measurable, and different from those that existed before. As always, perspective matters. Everything discussed here reflects analysis, not instruction. Markets do not owe anyone an outcome. They reward preparation and punish complacency. Stay calm, stay analytical, respect volatility rather than fearing it, and remember that in markets defined by scarcity and emotion, patience is not passive, it is an active advantage.